Alright, welcome back to Lunch at the Market. It is nice to see the momentum finally come out, the heavy selling finally abate in our high beta, high flying names like Deckers, F5, Networks, Salesforce.com, and Cree, and others. Volume has become almost anemic, especially in both Cree and F5, meaning that if you want in now, you're actually going to have to pay the price that you see on the screen, or you're going to have to pay higher if you want back in the stock. Because the people that were willing to sell at any price seem to have gone away. It is our thought, especially with Cree, that there was a big institutional seller that wanted out of the stock after the earnings. The stock for Cree traded about 17 million shares on the day after they reported earnings, which caused the stock to get whacked by about $9. That big institutional investor, who basically wanted out at any price, since then has moved on, and the stock has found heavy support around the $50 level. If that continues to hold, all of those short put spreads that we rolled down and out to the 50 strike will now be golden. Well, actually, they'll be worthless, which will be like gold, which is better than gold because gold has been terrible this month. Anyway, it's going to be good for us if the stock finishes above the $50 level because of all those strikes that we rolled down and out to the 50. All right, volume in Cree today is about 2 million shares. The volume is pretty anemic compared to that 17 million shares that traded. The average daily volume in Cree is about 7 million, so even if we double today's volume, you're still going to get under the daily average, which basically is showing us that the big institutions that wanted out have got out, and now those incremental buyers will actually take the stock higher. The other good thing is with the big institutions out, if somebody decides that they want back in, say Cree starts another quarter after quarter of beating expectations like they did for 8 quarters before they finally blew it big time last quarter, it means that an institutional buyer is still out there lurking, which is good for people who hold the stock. We're looking for about the mid-60s in Cree, and we're going to play it through A, our short put spreads, and then B, the in-the-money 2013 January 40 and 50 strike calls, right? Both of those are in the money. The 40s are obviously much more in the money than the 50s, but they're out to January 2013, so we have plenty of time for this story to play out. Next, Deckers is finally back above the $75 level, and volume has been progressively getting smaller in that one in the last 2 days. There's a big whoosh from basically 87 down to 72, which puts us right at about a Fibonacci retracement between 50 and 66%. Stocks usually overshoot both to the downside and to the upside, so we'll call it a 50% retracement, which is about the $73 level. We'll call it good enough for government work. We'd love to see Deckers hold the $75 level. It'd be nice to make our whole year in the month of February, but if it doesn't happen, no problem. We'll just keep rolling down and out. We do have many strikes hanging out there on the calendar below the 70 strike, right? So we're short 70, 65s, and 65, 60s further out on the calendar. So as long as Deckers holds the $75 level, it's going to be fantastic throughout the rest of the year because of the size of the position that we have on the short put spreads in Decker. With only 3 weeks left until options expiration, once we get to Monday, time is really going to be on our side, and this is a pretty short options expiration for February. All right, yesterday, Salesforce.com looked terrible. It was down another $3. We took the opportunity to swap out of our short 120, 115 put spreads that were short for this options expiration. We rolled a lot of those out to May, and then we added the short 115, 110 put spreads that expire this month in the front month. The goal was to get another $5 of cushion away from where we were short. It's really important for us, especially because of how many positions we had to roll down and out last month, that this options expiration we take in as much incremental premium as we can. That way we can kind of pad those positions that we've had to move further out of the calendar. So with that being said, we finally got over $1 for the short 115, 110 put spreads, and now that Salesforce.com is actually traded back up, we've got about $12 worth of cushion, and again, options expiration is on February the 18th. All right, most of the damage to the higher flyers that was done last in January options expiration is actually disappearing. Salesforce.com isn't reporting until the 23rd, which means that we have a good chance to escape this options expiration without much damage or having to roll down and out. All right, things are good so for us for today. Like I said, most of January's damage for options expiration has been undone. Don't forget, you can mention us on Twitter if you want to have us talk about your stock on Lunch of the Market. Thanks for joining us again today, and have a great day. We will see you tomorrow.